Have you ever wondered how credit scores work and how to rapidly raise your score? We're about to dive into the fascinating world of credit scores. Imagine a three-digit figure, a magical number that lenders, landlords, and even some employers use to assess your creditworthiness. This numerical representation of your credit behavior is your credit score. It's like your financial report card, reflecting how well you manage your money. Your credit score is used for a lot more than just getting a credit card or a loan. It can influence the interest rates you're offered, your insurance premiums, and even your ability to rent a home. But don't be daunted. While it's significant, it's also something you have the power to improve, so you're probably wondering, how can I raise my credit score? Well, stick around as we'll explore that in detail. Now that you know what a credit score is, let's unravel the mystery of its origin. The concept of credit scores isn't as modern as you might think. In fact, they've been around since the mid-20th century. But let's rewind a bit. Imagine a time when the process of getting a loan was based purely on a lender's subjective assessment. That's how it was until credit scores entered the scene. Credit scores were introduced by a company called Fair Isaac & Company, which we now know as FICO. It was the year 1956, and these scores were initially a tool for lenders, meant to make the process of issuing credit more objective and less prone to bias. FICO's scoring model was a game changer. It used mathematical algorithms to predict consumer behavior, which helped lenders assess the risk of lending to specific individuals. The credit score, a three-digit number, became a quick, easy reference to determine a person's creditworthiness and thus their likelihood to repay a loan. From the beginning, credit scores were based on several factors. These included your payment history, the amount of debt you owe, the length of your credit history, the types of credit you use, and how much new credit you've applied for. The weight of each factor might have shifted over time, but they all still contribute to your score today. As the years rolled on, credit scores began to influence more than just loans. They started to be used by landlords, insurance companies, and even some employers as a measure of responsibility. In short, these scores became a snapshot of our financial behavior, influencing many aspects of our lives. From the late 20th century to now, the importance of credit scores has only grown. Other companies like Experian, Equifax, and TransUnion have introduced their own scoring models, adding to the landscape. While the models may differ slightly, the core principle remains the same. A higher score equals better creditworthiness. From a tool for lenders, credit scores have evolved into a vital part of our financial lives. They have become a key factor in determining our access to financial opportunities, and understanding them is crucial to managing our financial health. So, let's dive deeper into how they work, and how you can make them work for you. A credit score is more than just a number. It's a complex calculation. It's like a puzzle made up of several pieces, each contributing a bit to the final image. To understand this puzzle, let's break down the pieces, the components that make up your credit score. First up is payment history. This is the big kahuna, accounting for about 35% of your total score. It's pretty straightforward. Lenders want to know you're going to pay them back. So they look at whether you've paid your past credit accounts on time. Late or missed payments. Those will put a dent in your score. Next, we have the amount you owe, which makes up about 30% of your score. This isn't just about the dollar amount though, it's about your credit utilization ratio, which is the amount you owe compared to your total available credit. The lower this ratio, the better for your score. Then we have the length of your credit history, which accounts for about 15%. This is the age of your oldest credit account, the age of your newest account, and an average age of all your accounts. Longer credit histories can prove you're a reliable borrower, which can boost your score. The fourth component is credit mix. This is about 10% of your score. Lenders like to see a mix of credit types, like credit cards, retail accounts, installment loans, mortgage loans, and so forth. A diverse credit portfolio suggests you can handle different types of credit. Lastly, we have new credit, which also makes up about 10%. Opening several new credit accounts in a short period can signal risk to lenders, particularly if you don't have a long credit history. And there you have it. Those are the key pieces of the credit score puzzle. Each one plays a part in your overall score, and understanding how they work together is crucial. Knowing these components paves the way for improving your credit score. So let's move on to discussing strategies to boost your score. Stay tuned. Improving your credit score isn't rocket science, it's all about financial discipline. Let's delve into some strategies that can help you elevate your score. First and foremost, pay your bills on time. This might seem like common sense, but it's worth emphasizing. Late payments can have a significant negative impact on your credit score. Set reminders or use automatic payments to ensure you never miss a due date. Next, keep your credit card balances low. Credit utilization, which is the ratio of your credit card balances to their credit limits, is a key component of your credit score. A lower utilization rate is better for your score. Aim to keep this ratio below 30%. For example, if your credit limit is $10,000, try to keep your balance below $3,000. Another strategy is to apply for new credit only when necessary. Each time you apply for credit, an inquiry is made on your credit report. These inquiries can lower your score slightly, and several inquiries in a short period can add up. It's important to be mindful of this when you're considering a new credit card or loan. Finally, check your credit reports regularly and correct any mistakes you find. Errors in your credit report can drag down your score. You're entitled to a free credit report from each of the 3 major credit bureaus once a year. Make it a habit to review these reports for any inaccuracies and dispute them if necessary. Remember, these strategies are not quick fixes. It takes time to build or rebuild a good credit score. It's a marathon, not a sprint. But with discipline and patience, every step you take brings you closer to your goal. So keep these strategies in mind as you navigate your financial journey. They're not overly complicated, but they do require conscious effort and consistency. The payoff, however, is well worth it. A higher credit score can open doors to better loan terms, lower interest rates, and more financial opportunities. Improving credit scores takes time, but with discipline and patience, it's achievable. Just as certain actions can improve your credit score, others can seriously harm it. Now it's time to pull back the curtain on those actions that can send your credit score spiraling downward. First on our list is late payments. Yes, folks, punctuality isn't just a virtue in social settings, it's equally crucial when it comes to your bills. You see, your payment history accounts for about 35% of your credit score. Therefore, consistently paying your bills late, or worse, missing payments altogether, can have a significant negative impact on your credit score. Next, let's talk about high credit card balances. Here's a little secret. Credit utilization, or the percentage of your available credit that you're using, makes up about 30% of your credit score. So, if you're consistently maxing out your credit cards, it sends a signal to lenders that you're heavily reliant on borrowed money, which can lower your credit score. A good rule of thumb is to keep your credit utilization below 30%. Now onto the big one, bankruptcy. Declaring bankruptcy is like dropping a nuclear bomb on your credit score. It's the financial equivalent of a scorched earth policy, obliterating your credit score and leaving a lasting mark on your credit report for 7 to 10 years. It's a last resort option that should be avoided if possible. Other credit score destroyers include foreclosures, collections, and hard inquiries. Foreclosures and collections can stay on your credit report for 7 years, while hard inquiries can stay for 2 years. While 1 or 2 hard inquiries won't do much damage, a series of them can add up. So there you have it, the actions that can negatively impact your credit score. It's crucial to remember that your credit score isn't just a number, it's a reflection of your financial responsibility. Treat it with care, and it will open doors for you. Neglect it, and you'll find those doors swiftly closing. Avoid these pitfalls to maintain a healthy credit score. Credit scores might seem intimidating, but understanding them is the first step towards financial freedom. We've journeyed through the fascinating history of credit scores and unpacked what exactly they are used for in the United States. We've also explored the key components that make up your credit score and the strategies you can employ to improve it. It's important to remember that getting credit is only the first step. Once you have it, you must work diligently to increase your score. This involves paying your bills on time, keeping your credit utilization low, and not applying for new credit too often. But beware, there are things that can seriously harm your credit score. Late payments, high balances, and too many hard inquiries are all pitfalls to avoid. In the end, the journey to a good credit score is a marathon, not a sprint. Remember, a good credit score is your passport to financial opportunities. Guard it wisely.